What are the tax implications of buying or selling a home? Whether you're a first-time home buyer upgrading to a new place or selling a property you've owned for years, understanding how taxes impact these transactions can help you make the best financial decisions. Today, we'll cover the main tax implications for both buyers and sellers, from deductions and credits to capital gains exclusions and special rules for investment properties. All right, so Spencer, today we're going to be talking about the tax benefits of buying and selling a home. So we'll start off with the tax benefits for buying. And sadly, a lot of these, as we are sitting with the Tax Cuts and Jobs Act, if you do not itemize your deduction, they may not apply to you. But let's go ahead and talk through them. Mortgage interest deduction. What is this deduction?
Well, this is one that you can include in itemizing your deductions. There are some limitations here. You have up to $750,000 if you bought the home after December 15th of 2017. The cap is $1 million on the mortgage if you bought it prior to that particular date. But you want to work with your CPA on this because the amount that you pay in interest will change every year. But again, it may not help you get north of that standard deduction because that's been doubled more or less since the Tax Cuts and Jobs Act.
Right. And another one that may or may not affect you is property taxes. So state and local property taxes on your federal tax return, those are capped at $10,000. So if you have, let's say, mortgage interest of $1,000 and you have a property tax that's $3,000, well, now you've got $4,000. You're not getting anywhere close to the $29,000 standard deduction for married couples. You're really not even getting that close to the $13,000 for singles. And so really, as we look at some of these buyer credits, buyer deductions, you really have to have significant itemized deductions to take advantage of some of them.
So you really need a significant mortgage, basically, is what we're saying, with a high interest rate to be able to get close if this is your primary way that you're itemizing. Now, we would also add in charitable gifts and medical expenses and other kinds of things, so they can stack up. But to your point, with a cap of $10,000 on state and local taxes, there, which would include those property tax pieces, we oftentimes will not see clients get above the standard deduction level. The other thing that we will include here as a reminder, if you're getting close, and let's just say that you're doubling up or tripling up even in your charitable contributions, so that you can get above and be able to itemize in particular years, also think about doubling up in paying your property taxes. This doesn't work for everyone everywhere, but it does work for us in Knox County at least, because you have the option of paying late in the year from, say, mid-October through the end of the year, or early in the year without being penalized, usually January and February. So if you wanted to, you could double up your charitable gifts in one particular year and pay 1 year of property tax in January, and then pay again the next year in late October or November, for instance.
Right. So two others that we'll say for buyers that you can look into are mortgage points deduction and deduction for private mortgage insurance. We would say on both of these, really work with a CPA because the rules are a little bit more challenging to walk through. So just make sure if those apply to you, if you use points to reduce your mortgage interest rate, or if you have PMI, make sure that you're working with a CPA. So the next one we'll talk about is the home energy tax credits. If you're a homeowner and you have decided that you want to install solar panels, wind energy systems, geothermal heat pumps, things like that, there's a certain list of things that within either the Inflation Reduction Act or prior to that you can take a tax credit on. Some of them are really substantial and that can be almost a direct dollar for dollar reduction. But really, you have to look and see, okay, what is approved? Mm-hmm. Am I working with a contractor that's willing to write it and make sure that all of the T's are crossed, all the I's are dotted? Make sure that you know that what you are installing actually applies. It can even be for things like insulation within your walls. But again, make sure that you're looking into it. Look at what's available. Talk to your CPA, as always, with these things. And that's one benefit and credit that you can take with as a buyer or as an owner of a home.
The other thing there is you've got to look at your historic zoning commission, just hypothetically, if you live in one of those, because they might not like solar panels or some kind of wind turbine on top of your home.
Yep.
But for those rest of you who have much more of an open system of government that won't prevent you from those kinds of ventures, you may be able to take advantage of it.
Absolutely. So let's talk about the tax implications of selling a home. This is oftentimes what our clients are more worried about or more afraid about. If they've lived in their home for 10 years, 15 years, and it's been anything like the real estate market for the last 10 or 15 years that it has been for us, then you may have substantial capital gains. And so talk us through what are some of those capital gains exemptions, and then what do we need to be concerned about as we look at selling a home?
Well, for most of our clients, again, they live there for some period of time. They're concerned, do I have capital gains that I'm going to be taxed on here? And what the federal government wants to do is provide this exemption for a certain level to say you don't have to keep track of everything, provided your gain hasn't been too great. So if we have a single filer, you have up to $250,000 of gain if you've lived in the home for at least 2 of the last 5 years. So they want to say, okay, if you've bought this home and you lived there a long time ago, but then you started renting it out, then we're not going to have that exemption that's going to apply. But if you've lived in that home and that's been your primary residence, and the, again, line of demarcation is 2 of the last 5 years, then it is counted as your primary residence, and we have this exemption, again, $250,000 of capital gains if you're single, $500,000 if you are married filing jointly. So to kind of put an example here, let's just say that 30 years ago, you bought a home that was $200,000, and you've been living in that home for the last 30 years, and you feel like, okay, it's time to downsize now. I'm in my, mid-70s, let's just say. Time to downsize, but the home is worth $700,000, and you think, good grief, this has grown a lot in value. Surely I'm going to have to pay some tax on this capital gain. Might not want to pay tax, but you think maybe I'm going to have to. Well, $200,000, if you have no other records, $200,000 would likely be your cost basis. Then that's what you paid for it. If you did capital improvements along the way, if you put on another room to the home, or did some other things within the home that wasn't maintenance, which we'll talk about the difference there between a capital improvement and maintenance a little bit later. But let's just say again, you started with that $200,000 as the purchase price. You have $500,000 married filing joint as the exemption. Okay, just because you have a sale of $700,000, you saw an appreciation that was very, very significant, but you still have no tax due, right, because you're right at the top of that exemption. So lots of different moving pieces there. If you say added a room and a bathroom, and that cost you $100,000, and so now we have a cost basis of, instead of $200,000, we've got it $300,000. Why, if you sold it for $800,000, then you would still be within that area where the capital gains would not be taxed because of the exemption if you live there at least 2 of the last 5 years.
Right. Well, and so let's talk a little bit about capital improvements versus maintenance. And so we'll just use this hypothetical situation where you have a child who decides that it's a great idea to kick a soccer ball at the house. And that soccer ball may or may not go through the window of the house. If you were to just replace the pane of the window, the single pane that broke, that is maintenance. Now, if you said, well, all the windows in my house are 40 years old, and I need to replace all of the windows and make them more energy efficient windows, the maintenance side of things is replacing the single pane. That is not adding to your basis. If you replace all of the old windows with new energy efficient windows, that then adds to your basis. It is an improvement that you're making to the home. Right. But this would never happen in either of our situations.
No. And similarly, if your child just took a crayon and marked all across all of the walls in your downstairs and you had to repaint them, that would be within the context of a repair and general maintenance rather than a capital improvement, even if you painted a color that you like better going forward.
Yeah. Okay, so let's now talk about some of the tax implications for selling an investment property. We've talked about this in the past. You can look at one of our previous videos about owning rental properties and what are some of the tax implications. But the reality is there's a little bit more of a nuance and a difference. So talk us through maybe some of the basics, and I can talk us through the fun piece, which is depreciation recapture.
Well, we want to recognize that with investment properties, we don't have that same exemption level. So if we've held the property less than a year, Then we've got short-term capital gains. If we've held the property longer than a year, oftentimes it would be long-term capital gains. So we look at those and we want to make sure that you understand that if you've converted, let's say you even had a primary residence and then you converted it to an investment property, then you're still going to have the same conditions here where we've got to be tracking long-term capital gains. Now, the flip side is that we get this nice feature called depreciation. Why don't you walk us through that?
Yeah, so depreciation, the schedule for rental property depreciation is 27.5 years. So what you're going to do is you're going to take the value of your home plus any capital improvements that you've made, and you divide that by 27.5. And that is what every year you can reduce the amount of income that you have by depreciation. And so let's just make the math simple. You have $20,000 of annual income on your rental property. If you can depreciate $5,000, then you get to reduce that income from $20,000 down to $15,000. Now, that sounds great, and it is great on a year-to-year basis, but let's say you hold that property for 5 years, and then you decide, okay, now it's time to sell it. And every year you've accounted for and you have applied for depreciation. Well, now you've got $25,000 that's not going to be taxed at your long-term capital gains rate. It's going to be recaptured. The government has said, hey, you've reduced your ordinary income that you've been filing for the last 5 years. Now it's time to pay us back. And so your depreciation recapture is going to be set at your ordinary income rate up to a limit of 25%. And so if you have been depreciating the property when, let's say, you're at a tax bracket of 10% or 12%, then you jump up, and when you sell the property, now you're at 22%. Well, that depreciation recapture, you might be paying 22% on it, where your income may have been less. And so you just really have to be aware of this. There is that side of things when you sell an investment property, just to be aware of. And one other thing to note with investment properties is that you can defer some of those taxes through a 1031 exchange. The nuance of this is really complicated. There are time limits, there are property limits. So we would say if you are going to look into a 1031 exchange, this would be selling a rental property and buying another rental property. It has to be done within certain windows, and there are lots of ways that you can hang yourself on this. And so really, if you're looking to do a 1031 exchange to defer some of those capital gains, really you need to work with a real estate agent, you need to work with a CPA before taking action on that.
Usually there's a transfer agent that's fairly specialized as well. So you want to make sure that you have your ducks lined up and that you plan far in advance on this because of the element of complexity.
Yeah.
Every now and then, folks will also pose the question of, well, I do work at home some. Does it make sense for me to have a go at the home office deduction? Sometimes it can make sense, but there are a lot of ways that, again, you can harm yourself if you go after this and you don't have your ducks in a row. First of all, I think you need to know with the home office deduction, whatever part of the home that you're trying to get a deduction on, it has to be solely for that business, solely for that. It can't, you can't commingle that with, okay, well, I take my kids in here and we play violin in this room, and then part of the other time I do business in here and make my phone calls and have my home office. It doesn't work like that. It's got to be solely dedicated there. There are lots of different things that you've got to do in terms of calculating the portion of expenses that you might have for your home, utilities, repair, mortgage interest, all those different kinds of things to make sure that you're not overcounting that for the home office portion of that deduction. So oftentimes as we look at this for clients, there might be a potential that they could get a deduction here, but there's a greater potential that it causes a red flag and the IRS comes in and they might not get the deduction to begin with, but it creates a tremendous hassle. So be cautious about applying for that home office deduction. It would be our counsel usually. But if your CPA says go for it, then follow your CPA's counsel for sure.
Absolutely. So as we wrap up today, just a couple things that we want to come back to with anything that has to do with taxes. Keep really detailed records. If you have records of when you bought the home, what the basis was, what capital improvements that you did, when you did them, it's really important to have those on file in case an audit were to happen. Always think about how you're timing the sale of your home. if you have converted to a rental property, or if you moved and had a property in a different city that you wanted to maintain. If you decide in 3 years, hey, I want to sell that, okay, you may still be within that exemption window. But if you wait for another 2 years, then you're outside of it. So really think about, okay, do you really want to hold that property? Or is it just because you have maybe some sentimental feelings that you want to keep it? There's a lot of factors to consider, whether you just decide to rent the home or decide to sell it. So make sure you're timing it wisely. And always use a tax professional. Real estate is one of those things where there are so many different levers that can be really complicated. And there are lots of IRS rules regarding that. So work with a real estate professional, work with a tax professional that understands real estate. Anything else that we would need to really think about before we close out today, Spencer?
I think the overarching key is don't look at real estate as a massive opportunity to save in tax payments. There are certain things that you can do that can reduce your tax bill, but you want to make a decision about whether you make an investment in real estate or the home that you buy, irrespective of these tax considerations usually. Now, every now and then there'll be a circumstance where we say, okay, well, I know I'm going to sell the home in the next year. I'm bumping up on this 5-year time period. I lived there, a few years ago. And so that may accelerate that decision, but it's generally quite rare. What we want to do is just recognize that there are tax implications, that real estate is one of those areas that we want to be mindful of that, garner the advantages, but not make purchases just because we think we're going to get some kind of big tax write-off.
Right. Well, and with that, clients, if you have questions about your real estate holdings that you have, or maybe that you want to invest in, we would love to have that conversation with you. Always feel free to leave comments down below, and we will see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.